Hello, this is Dr. Seitz, and today I thought we would go through a problem for Chapter 2, basically going through some accounting cycle problems for 3 years. So we have some events here. I have copied this information and it's available to you, but this is the information I will be using as I fill out the work papers. I have it printed off to the side here so I can be reading it, so I won't have to be flipping back and forth as I go through and reading that. But basically, I'm going to just take this information, put it in the horizontal financial statements model, and identify items being operating, investing, or financing in the cash flow, on the cash flow statement. Okay, so I'll go ahead and get started. So computer services company for year one, the very first transaction that they have for year one is they issued $9,000 common stock, and it was what started CSC, the company. So we can see here it's already written out for us, $9,000. And on our financial, right here, on our financial statement, or on our horizontal analysis, we can see that $9,000 in cash, and then our equal sign, so we make sure that we have a balanced accounting equation, equals liabilities of 0, and then stockholders' equity, specifically common stock of $900,000. Anything that has to do with stockholders' equity items and long-term liabilities are financing activities. So you can see how that's listed off to the side there as a financing activity. So that one's already done for us. The second one, they borrowed $5,000 from the bank. So I'm going to put a $5,000 increase in cash here, but that's also an additional $5,000 increase in notes payable. That does not affect the income statement, just like our prior transaction. So I'm going to do an increase in cash over here for the statement of cash flows. And that's a long-term notes payable, long-term liability. So that's, again, a financing item. The company provided services to customers and received $4,000. So they did what they were supposed to do. They are doing services and receiving cash for that. So I'm going to increase my cash. And additionally, I'm going to increase my retained earnings. And that increase in retained earnings is specifically because there's an increase in revenue. So you can see here I did an increase in revenue. Therefore, on that specific transaction, there's a $4,000 increase to net income. And that $4,000 will hit the cash flow statement as an operating activity, because operating activities are specifically what the company is in business to do. So 4, they paid operating expenses of $2,900. So I'm going to decrease cash by $2,900. And then I'm also going to decrease retained earnings by $2,900 to signify an expense. And I'm going to put this in here as $2,900, and then also decrease over here as a negative $2,900 on that specific transaction alone. And then show that $2,900 went out in operating expenses. And you can see that as, or operating activities on the cash flow statement. And then additionally, they paid $500 in dividends. We're going to see a decrease in dividends, a decrease in retained earnings, not because it's an expense. So you're going to see that I'm not going to put anything here because dividends are never expenses. And then I'm going to show a $500 decrease here. And because dividends are a distribution to owners, that's a stockholders' equity item and therefore a financing activity. Now, our balances are already calculated for us here. You can see these balances as they fall through the cracks here. You would be able to prepare your financial statements by preparing your income statement with revenues minus expenses, showing your net income of $1,100. You can also start with your statement of retained earnings and your beginning balance is 0. And then you're going to add your net income, which is this $1,100. You're going to subtract out your dividends, which is this $500, and that would equal your ending retained earnings. Okay. And then after you complete your retained earnings, you can actually prepare your balance sheet. And all of these balances that we have here, these totals, these balances would fall through on the balance sheet. So assets equal liabilities plus stockholders' equity. You can see that we would have the assets, liabilities, and stockholders' equity, and you would be able to prepare your first year balance sheet as well. Now, following through to year 2, the very first thing that I want to point out is that these beginning balances from year 1 will fall down here and be year 2, or sorry, these ending year balances for year 1 will fall down and be year 2 beginning balances on the balance sheet. So you can see that all these balances will fall down here. Income statement items, they are temporary accounts. So income statement measures revenues and expenses for that current period, and in our case, a year. So there will not be any beginning balances here. And then additionally, cash flows start over as well. So our beginning balances would fall through, like I said, and so we'll go ahead and get started on year 2 transactions. The company issued additional common stock for $4,500. So I'm going to increase my cash by $4,500. And a lot of these are going to be the exact same that we've done before. So I'll probably go through these a little bit faster. So increase the cash, increase the common stock. That's also going to increase my cash flow, and that's a financing activity. They paid $2,000 to reduce liabilities. I'm going to decrease cash here, and I'm going to decrease those long-term liabilities there. Again, nothing hits the income statement, and I'm going to show a decrease in cash. And because it's a long-term note payable that decreased, that's also a financing activity. 3, the company provided services to customers and received $6,700. So I'm going to increase my cash, increase my retained earnings, because an increase in retained earnings is done by revenue. And this is what they're supposed to be doing. So this would be an operating activity. 4, they paid operating expenses of $4,300. So you're going to see me do a decrease there, a decrease in retained earnings, a decrease over here showing the expenses, or negative on that transaction alone of $4,300, and then an operating activity cash flow outflow of $4,300. 5, they paid again $700 dividends. Nothing here. Dividends never hit the income statement. A decrease over here, and that's again a financing activity. Just as before, all these balances, ending year balances, are calculated for us, so we don't have to worry about that. You can take this information and prepare your financial statement, starting with your income statement. Starting with your income statement here, revenues minus expenses equals your net income. You can start with your beginning retained earnings balance, which was $600, plus net income of $2,400, less dividends of $700, should equal your ending retained earnings of $2,300. Then you can prepare your balance sheet. So we have assets equals liabilities plus stockholders' equity. So all of that information can be prepared after you are done with this horizontal analysis. Okay. Let's move on to year 3. We know, just like year 2, year 3 beginning balances. Year 3 beginning balances are year 2's ending balances. So those are just going to drop down, drop down, drop down. These start over, okay, because those are temporary accounts. So for year 3, they issued additional common stock for $2,500. So I'm going to increase my cash by $2,500, increase common stock for $2,500. Nothing to do on the income statement, and then increase my cash flows for $2,500, and it's a financing activity. 2, borrowed additional $1,000 from creditors. So you're going to see me increase cash, increase notes payable, skip the income statement, and then increase cash financing activity. 3, provide services to customers and receive $7,400. So I'm going to increase my cash for $7,400. I'm going to increase my retained earnings by ways of revenue. Revenue increases retained earnings because net income increases retained earnings. And this is what we're supposed to do, operating activity. 4, operating expenses were paid of $7,900. So you're going to see me decrease the retained earnings because expenses decrease retained earnings. Okay. And then 5, they paid dividends to stockholders. You're going to see a decrease in cash, decrease in retained earnings, but that does not hit the income statement because dividends are returned to the investor, financing activity. And then a new transaction is that they paid $21,000 to purchase land. So you're going to see a decrease in cash, but you're going to see another increase to land. So you're just basically rearranging your assets there. Nothing hits the income statement, but what we do see is a $21,000 decrease in investing activities. So investing activities include long-term assets, anything to do with a long-term asset. So this is a purchase, so that's why you see an outflow of the investing activities. Now, if you were to prepare the financial statements, you would again look at your net income here. You have revenues minus expenses equals your net income. Okay, so you'd be able to prepare your income statement, start with your statement of retained earnings for year 3, where you would have a beginning balance plus net income less dividends equals your ending balance. Okay, and then you'd be able to prepare your balance sheet. So I'm going to move these so I can see. Okay, so with your balance sheet, you would be able to, I want to point out that this is actually a miscalculation. That should be a negative 18,300. Okay, so we would have assets plus liabilities equals stockholders' equity. And so basically, if you added all your assets up, they would equal your liabilities and stockholders' equity. And so we would see that our balance sheet would balance because assets equal liabilities plus stockholders' equity. Okay, and then you'd be able to take this information here for each of the years and prepare the cash flow information. Now, with the cash flow information, you need to know the beginning year cash balance and the end of the year cash balance, which all that information is on this financial statement analysis that I prepared. And just an FYI, this information is getting us ready to do journal entries. This isn't something that's used in practice. It's good for us to practice this way, but it's not used in actual accounting practice. Let me know if you have any further questions.